Thanks, Mukesh. We'll now go over to the Q&A where we have quite a few questions. So the first question we have is, what are the new jurisdictions entered into in Europe, which were exited? I'll start with those two to start with. There's a few more.
Yeah, so the new jurisdiction, we've set up a company in Italy, and we're in the process of setting up the collection program for our pan-European collection program in Europe. We've also scaled back the collection program in Spain. Spain was generating reasonable revenue, but not very profitable. So, and then the third piece is also in Germany, where we've got a new OEM that's joining the program, which will then improve the profitability of the German operations as well.
There was no revenue growth in Europe over the half. Why not? Have the operations in Europe now scaled?
No, they have not. The changes that have taken effect really, we've scaled back the Spanish operations during the half, but the Italian operations actually haven't come online yet during this reporting period. Neither has the impact from Germany. We've also picked up quite a bit of work in the UK, where we haven't been able to access that until most recently, and it's really in the second half where we've won the contract, but we had to put in place a number of government requirements because of Brexit, where we needed bank guarantees and the like to be able to ship product from the UK to Europe because it's deemed to be a waste product.
In previous presentations, it was forecast that the full effect of the Europe operations would materialise in the current financial year. Now it has been pushed back to FY27. What has been the cause of the delay, and what does management think about this?
Yeah, so we've won a number of new contracts in Europe, but the timeline for them to come online has taken longer than anticipated. Some of it also is working with the OEMs to make sure that they have the funds in their budgets, in their budget process. Some of them have, 31 March year ends, and so they need to get to the 1st of April where they've built into their budgets the additional spend for some of the services that we've been awarded. But yeah, certainly FY27 is when we expect to see some of the programs coming on, and some of these things just take longer than anticipated. We've seen this before in other businesses, units in the group, where you win a contract and it takes a long time to unwind the existing relationship. Similarly, it works on the other end for us as well. So once you get the contracts, they're quite sticky. Don't you want to add anything to that, Kesh, in terms of our experience?
Yeah, essentially these kind of programs have a ramp up phase, and they're at the mercy of the returns of the market. So transitioning from different suppliers when we win contracts takes time. It could take three to 6 months, sometimes more, depending on how big the customer is. But the business is actively focusing on increasing those engagements so we can get the returns quicker.
Okay, and to Asia, the company has not disclosed any particulars of its ITAD or resource recovery operations in Asia. What is their nature? Isn't it the case that Closed Loop only has ITAD facilities in North America? There has been no disclosure of the commissioning of facilities in other locations.
That's for you, Kesh.
I can answer that. So we have ITAD physical facilities, North America, in Belgium, as well as Australia. The operations in Asia, we're using third-party partners over there to grow our Asia Pacific program. And these programs will run like that for quite some time in the Asia Pacific till we see increased volume and commercial viability to decide whether or not we can set up our own facility in Asia.
Okay, with ITAD, Closed Loop has been forecasting for a year and a half now that ITAD is subject to temporary headwinds due to resolve within the coming months. But the deterioration of business has taken place over an extended period now. This would suggest that deterioration should not be framed as temporary. Can you make some comment on that?
Yes. So in relation to the ITAD, we've certainly taken on a number of new programs. We're seeing increased volumes over more recent months after a lull. So we're starting to see a pickup in that business, but it wasn't necessarily reflected in the first half of this financial reporting period. But certainly the performance of that business has been stronger in the last couple of months, and certainly January and February.
Can you make some comment on the 30 days return service? What has happened here, and is there any prospect of recovery? Or what's the status of the HP contract? Yeah, if you
Well, let me
provide
answer
some
that.
comment on that.
Yeah, the HP contract, our relationship with HP has never been stronger. There was a round of restructure, if you like, at HP. But as a result of that, we've come out and we have a relationship now, talking to our US team literally last week to say that our relationship with HP is as strong as it's ever been. There was a period of time during the reporting period where the guys were concerned and there was a lot of upheaval and a lot of change at HP, but that all seems to be put to bed. And as a result of getting a stronger relationship, the guys are confident of being able to pick up new opportunities going forward. And I know that picked up in the last few weeks, whilst not in this reporting period, but certainly in the last few weeks, that picked up some nice one-off programs from HP in that 30-day return space.
Can you make comment on the reduction in inventory? It's been minimal after the backlog during the Mexicali commissioning. Is Closed Loop going to make better progress against this backlog in the next half?
The answer for that is yes. It's taken us a period of time. We said in the announcements to scale the facilities. We've indicated that the Mexicali facility is ramping up. And for example, it might take them, an hour to do a laptop. As they get more knowledge and know-how, as they get more efficient, as they do more, that laptop might take half an hour to do the same process. So it's a matter of increased learnings through the process. It's not like we bought the facility, we turned it on day one. We did certain tasks in the beginning. We've added more products. We've set up the paint booth and other services that we're now offering out of that facility. But each time we offer a new service or a bit of an improvement, it takes time to build the knowledge and know-how to get the efficiencies. And so it's taking time. And that's not unique to Close the Loop. Any business. There's not many businesses where you just drive your car off the showroom floor at 200 kilometers an hour. It takes time.
What's inflating the cost of doing business? The release mentions, and then following from that, the release mentions new OEMs and customers more than offsetting a drop in cartridge take-back in the US. Which services does this relate to?
Well, that relates to the print consumables. There's a couple of new OEMs that the guys have won out of our Kentucky facility. And so there's some revenue associated with that, albeit not very much in this half. There's more that will come in the second part of this financial year, as well as going into FY27. And so, generally, Kesh, you can probably talk to us better than I can in terms of the take back of cartridges and what's happening in the markets.
Yeah, I mean, with the cartridge market, we're looking to scale up and get more returns and increase the program through the customers. But just to answer the question, there's another question that's inflating the cost of doing business. I think was the first question to that question, Daniel.
Yeah, correct.
Just to touch on that, what increases the cost in the ITAD business is the time it takes to process lower grade assets. So if we get a laptop that has scratches or the screen is damaged, then the time taken to fix those things is much longer compared to receiving a laptop that doesn't have those damages. So we're able to turn around quicker and the direct cost is lower. That's really what's driving the cost. And as Mark mentioned before, we just started, so we can't take off at 200 k's per hour. There's a learning process where we have to put in automation and get better at these fixes and repairs for the laptops to be able to reduce the cost and increase the margin. Yeah.
I have a question via email. Were there any proceeds from non-core assets? What other non-core assets are being reviewed for disposal?
So there were no proceeds received in this reporting period in terms of others. So that's the first question. The second question, what other assets are being considered? That's not in the public domain. The business is still working through, as we've indicated, our strategic review, and we'll update the market once we're finalized through that process.
Okay, on data center decommissioning, Closed Loop has in the past expressed the desire to get involved in this area, given the huge growth. Has Closed Loop gained any traction in this area? Can you provide more detail?
Yes, I can answer that, Mark.
Yep, sure.
So in the Australian corporations, we have got data commissioning programs with some key clients. We're looking to scale that in other areas. This opportunity actually came from our ITAD business in America, and we're actively working to increase the volumes. However, it's very cyclical. These jobs, the data commissioning in data centers happen once every 3 years or once every 5 years based on the turnover of the assets. So we had an influx last year. So we're expecting lower returns the following years, and it will increase again on the third year. And while we're doing that, we're trying to expand our customer relationships and find opportunities in Europe as well as America.
A general question. Closed Loop is burning cash half on half with a debt burden. Is there any realistic prospect that the company can return to trading levels, for example, at least the 2024 levels, whereby it could achieve positive cash and pay down principal?
Yes is the answer. Otherwise, we wouldn't be in the business at the end of the day. We're adamant, and you can see by the improved performance of the packaging business. We've indicated through the announcements that the packaging produces strong free operating cash flows. We have continued to pay down debt. We haven't missed any debt payments or repayments. That's why I made a comment in the presentation that I actually just said that borrowings have decreased from 85 million to 81 million over the 6-month period. And it was 88 million this time previously. So in the previous corresponding period. So the debt is decreasing. It's just that we've utilized some of the cash, and we're confident that the business will produce free operating cash flows in the future that will put us in a stronger position. And in fact, over the last quarter, whilst not reflected here, but certainly over the last 3 months of trading, we've seen our cash improve and produce positive cash outcome for the group, across the group.
I think that answers the next question. Over what period is such a recovery expected, if this is still possible? Mark,
Yeah, I think I've just answered that, Daniel.
Yeah, and then just to follow on to that, Mark, in the last half, the company predicted a return to robust profitability in the US ITAD business in the current financial year. What are your reflections given the first half, which doesn't have that robust return to profitability?
Yeah, that's a good question. It's taken us longer than anticipated, and also what's happened is that our new CEO in the North American business has had to get the processes and procedures right in place for the operations to convert our stock into cash quickly, to get the processes and move some of the processes that were being done in our South Lake facility in Dallas, Texas, down to Mexicali. So there's been a number of changes that have been made in the back end. It hasn't reflected to date in the financial results, but the building blocks have been put in place by the new CEO and the new team in North America to allow the business to perform better in the future.
Okay, we have another question. Your packaging revenue is up, but it looks like your profits are down. What's the reason for this? Why is the company spending more?
Yeah, I said before in my update that revenue in packaging was up 18% and EBITDA was up 27%. Right, that's the true measure of the performance of the business. Right, so revenue's up and EBITDA is up in that segment.
What has happened to your plan to move to a non-executive member of the board who has the ASX experience and who is looking after shareholders?
You want to answer that, Kesh? You want me to answer it?
Yeah, we both can answer. I'll start off. We're actively doing a strategic review now of the entire business, and part of that process is to look at non-executive directors for the business. And we will start that process after the strategic review is completed, which we hope to do in the coming months. And I'm sure Mark will be in the forefront of handling the communication protocol for that. And if you want to add more to that, Mark?
Yeah, just one further point, spot on, Kesh. As a board under ASX corporate governance reporting, we're required to maintain a skills matrix of the skills that each of the directors are bringing to the board. Part of the strategic review is to look at the skills matrix. Where are there shortfalls? Where are we missing Do we have a finance person? Do we have a sales and marketing person? Do we have a packaging person? Do we have an ITAD person? Whatever it might be in the skills matrix. So creating the skills matrix is the first step. We're working through that. And then we go back to market and find a director that can complete or fill in some of the gaps that we've identified through the review process.
What has happened to the cost-cutting exercise? Can you talk to that in more detail?
You want to talk to that, Kesh? You want me to go?
Yeah, we touched on it earlier. I think in terms of cost cutting for the group, we're really looking at divesting underperforming businesses. That's where we can really save cash and remove the financial burden on the business. And as we continue to do the strategic review, we'll make further changes if and when necessary.
I have another question here from email. What is the value of the proceeds to be received in the second half from the non-core divestments?
So, what is the level of proceeds?
The proceeds, correct? Yeah.
Yeah, it's approximately about $1 million in the second half, up to in cash.
The half-year account suggests both tranches of the $15 million convertible were exercisable at the company's option. Can you confirm if this is correct? And also provide an update on how this is expected to be dealt with, given we are only a couple months from expiry.
Yeah, so I can talk to that. There's two convertible notes of $7.5 million each. One of the notes is convertible at the discretion of the company in cash or shares, with share price set at 74 cents a share. The second note is convertible at the discretion of the note holder into cash or shares. Naturally, the note holder would want cash rather than shares at 74 cents. We are going to be working with the note holder to determine and renegotiate to obtain a positive outcome for all parties. The note holder is a major shareholder who's aligned with the strategic direction of the business. So it's something that we'll be working on over the coming months to get an outcome that's best for all shareholders.
Has the US ITAD business lost any customers or programs since being acquired?
No, it has not.
Will amortization of non-current assets discontinue going forward post impairment?
No, that's not correct. So the way the amortization works is when you amortize the intangibles, the first thing that the amortization or the impairment is set off against the goodwill. The goodwill is not amortized. The goodwill just is subject to impairment testing at the end of each reporting period. So the first step you do is, for example, if we're carrying $10 million worth of goodwill and there's an impairment charge of $15 million, the full amount of $10 million of goodwill is written off. Then the balance of the $5 million of goodwill in this example would be apportioned based on the ratio between the customer relationships, brand names, and internally generated software. And there'd be an additional amortization over and above the normal amount that's written off each period. So there will still be amortization going forward, because whilst we wrote off all the goodwill associated with the ISP acquisition, we didn't write off all the intangibles associated with brand names, customer relationships, and internally generated software, albeit the cost will be lower.
What has driven the improvement in gross margin?
I think we've touched on that already, Daniel. Product mix, price rises in some businesses, product mix in some businesses. There's no one magic bullet. There's a number of steps we've taken across the group to improve gross margin. The one thing I didn't touch on is, the more that Mexicali can process, we've indicated before that would also improve our gross margin across the business. So that's something I hadn't touched on and overlooked.
Where do you expect growth to come from in the second half? Has the business effectively bottomed in terms of earnings during the first half?
Kesh, you want to start and I can finish?
Yeah, just following on from the presentation, we see the biggest growth right now based on our past performance is from our packaging division, especially in terms of generating cash and increased profit margins. And we're looking to expand out to countries like New Zealand and South Africa in the coming year.
Yeah, and then I think the question is, has the business bottomed? I'm not sure what we mean by that. Is that we've hit the every business can improve. We expect our business to improve. Otherwise, we wouldn't be in the business, essentially. And I'm not sure what the question's really trying to get at in that one. Apologies.
Net debt has increased due to costs with divested businesses. How come you've sold the business units? What about the money you sold the business units for?
Yeah, I think I've answered this one already. As I said, the funds were received in January for the business that we sold, but we incurred costs through the sales process where funds were only received in January to offset some of the costs. So it's a moment in time at 31 December. Yeah. So that's where we stand with that one.
Will the business generate positive cash flow in the second half and the full year overall?
We expect it to generate positive cash flow in the second half, absolutely. Whether that's sufficient to offset the first half, it's a matter of timing.
At the AGM in November of 24, there was a change in the board. The share price was in the mid-20s. Can you just talk to what's been achieved over the last 15 months to rebuild confidence for shareholders?
I can answer that, and Kesh, best you answer it, but I was on the board at that time. So that's why I chuckle when I see this question, because I was one of the people that came off the board and the share price has gone down. No, I say that tongue in cheek, but certainly, as Kesh indicated, we're going through a process through a skills matrix to look for appropriate non-executive directors in due course when the time is right. They'll be appointed to the board. Kesh, I don't know if you want to add anything to that.
No, apart from, I think the key point I've been working on, I guess over the last 6 months, is the strategic review to increase the shareholder value, and that's obviously a focus on a daily basis. But in terms of business turnaround, we're looking into just the areas where we've got higher margins and cash generation, and that's why I guess divestments is key at the moment, and also to focus on our sales growth in the packaging space.
What is the utilization level of the Mexicali plant? How much revenue can the facility generate at full capacity?
If I can answer that one quickly, the Mexicali facility is currently only running on a single shift. So obviously you can run it on 3 shifts and you can triple your capacity. It's not so much the capacity, it's about having the feedstock to run through the facility. So it's about winning enough ITAD work and winning more work that's profitable, that can be done profitably, rather than just filling the facility to run at 120% utilization. It's really got to be profitable work that you're doing in the first place. But it's running on a single shift, so there's plenty of capacity in the business.
There's a question for you, Kesh. In light of the recent financial performance challenges, could you outline the strategic direction for restoring momentum?
Yep, I think that was covered in the outlook slide. The key focus areas for the business is to ensure, first off, that we are reducing debt for the business and creating a better balance sheet. And the easiest way we can tackle that is looking at the high-performing businesses and promoting growth in those areas, as well as making sure we've got really good cost controls moving forward, which in essence will strengthen the balance sheet, and strengthen the balance sheet increases our equity, as well as increasing our earnings per share. So all in all is to protect the shareholder interests and also increase the value proposition for our shareholders.
Do you have an
Daniel.
do you have an absolute or EBITDA margin target for the resource recovery business?
The answer is no, there's no absolute. At the end of the day, and I've said this before in previous updates, we pay the bills with dollars, not percentage points. As long as we're getting more EBITDA through the business, that's got to be beneficial for all shareholders. So, for example, Analysts always ask me, "Mark, your gross profit margin's gone up to 34.4%. Can it go up? Can it go down?" I said, "It's not relevant what the percentage is. It's relevant what my gross profit dollars are." Because in this case, it's the EBITDA dollars. It's the EBITDA dollars that are most important to us, not the percentage. Would I rather continue to run the business and get new work that can generate me, say, 8% EBITDA, but it's still profitable and still flows through to the bottom line, making an overall contribution? Or would I say I can't do that because it's only 8% and we can only do 12%? So, the percentage is a bit of a misnomer. It's got to be looked on each case-by-case basis of what you're doing as you grow the business, rather than saying we've got an all-out target number.
Can you talk about the convertible note? How have discussions with Sammy regarding this been going? Second, do you have any outlook, especially in regard to cash collections and cash flows going forward, despite the positive adjusted NPAT cash flows, negative cash flows? Will this continue with the debt balance? I think you've answered a lot of that already.
Yeah, well, I've certainly answered the question on the convertible notes. As I said before, I'm not going to repeat the answer there. And the second one is cash collections and cash flows going forward. It's really a comment rather than a question, because it says, negative cash flows will continue to increase net debt. That's correct. I'm not sure what the question is yet, Daniel.
Yeah. What concrete actions are being taken to restore shareholder value in the near term?
Well, I think Kesh has answered that when he said we've undertaken a strategic review, and as we complete the strategic review over the coming months, further market updates and announcements will be made as and when required. We're acutely aware of our continuous obligation requirements. We need to keep the market informed as we make changes and as things happen, and we'll continue to do that. We've certainly complied with our continuous disclosure obligations to date, and we don't see that changing. When there's something to tell the market, we'll tell them.
After the lower EBITDA in the first half, what gives you confidence that the business can return to historic profitability levels, and within what time frame do you expect this to happen?
Well, I don't think we can put a time frame on. We're not, because we're going to be held to that. We're not going to go on the public record and say it's going to be X or Y, because there's no winners. It's like asking to give a forecast. We know what happens in the market if you give a forecast. If you achieve it, you get a tick and nothing happens. If you don't, the share price gets decimated. It's a similar situation here. So we're not going to say we're confident that the business will grow, continue to grow, but we're not going to provide guidance in any shape or form, and because the downside significantly outweighs the upside.
What is the current rate of interest and any penalties applying to your bank debt? Is there any offset for cash?
Well, we actually have a negative carry because the bank debt carries interest, and we've indicated it in the half-year review report, around about 11%, whereas the cash on hand on term deposits sits at 4 or 5% on term deposits. So there's a negative carry associated with the debt. One of the parts of the strategic review is, should we be taking the debt that's sitting in the term deposit and paying down core debt, because there's a net saving for shareholders, and that's going to be in the best interest of shareholders. And if we don't have a better use of the funds which can generate a greater return than just using, forgetting weighted average cost of capital and everything else, if it's not making us 11%, then we better give the money back to the bank. And that's a simple way of looking at it, but that's the reality, and that's part of the strategic review that we're going through.
We've got another question on covenants, breaching covenants. How close are you? I think you've provided comment on that, but any more detail you want to add on that, Mark?
No, only to say we've complied with all the covenants of this in this reporting period. It's not relevant how much or how little, and I couldn't tell you off by heart anyway.
What are the main trends in revenue and margins expected into the second half?
From a packaging business, we expect continued growth in the packaging business. If the margins stay the same, that's a good outcome for us. Certainly, we expect there to be. We've won a number of new contracts across the group. The question is, how much of that we're going to see in the second half of this year, and how much of it is an FY27 story. And there's a lead time for what we do across the different businesses, whether it be packaging or resource recovery. There's a lead time. So yes, we sign a contract, but we don't always see the revenue for up to 6 months. And even then, even if you think about packaging, you've got to make plates and cylinders. In the case of Resource Recovery, they've got to unwind some existing relationships. It takes a period of time. The positive story here, the messaging here is that, we've been successful in winning new customers, new contracts, and that bodes well for the future of the business. But I can't say it's going to be a magic wand that's going to switch on the 1st of March or this second half. It's over a period of time, and that's the key messaging here, is that there's positive things happening, there's good things happening in the business, but it takes a bit of patience.
The HP contract subject to expire in October 26. Have you had discussions regarding the renewal?
There's ongoing discussions with HP all the time. We don't see that. Historically, when contracts like this have renewed, they've really just extended the date rather than go through a whole renegotiation. It's still too early to go through that process, but as I said earlier in the call, our relationship with HP is as strong as it's ever been. So we're pretty confident, and we're not concerned about that date at this juncture.
Can you provide more comment on the Mexicali facility? Is it now fully operational? What's the spare capacity? And what's the utilization level currently? What's that expected to be going forward?
I think we've answered that question already, Daniel.
Yep. Okay. Synergies. Are there synergies between packaging and resource recovery divisions? How do they increase Close the Loop's value proposition?
You want to talk to that? Or you want Kesh?
Yeah, I can talk to that. So the key synergies between the two divisions is our ability to, in the resource recovery division, collect end-of-life soft plastics packaging, and then convert that with our toner product into a natural additive called Tonerplast, which increases the performance of roads. And this is also a great sustainability story that the packaging customers are after. So they want a story around how well do we neutralize carbon, and how well do we have these processes that can offset negative environmental impacts, and having the resource recovery division there to be able to collect soft plastics packaging that our packaging division is correct for their customers and turn into environmental sustainable products. That's essentially how it increases CLG's value proposition. It also allows us to go after some of the larger contracts with bigger tier 1 customers that have stronger ESG goals. I don't know if you want to add more to that, Mark.
No, that's good.
Okay, that's all the time that we've got for questions today. So I wanted to thank Mark and Kesh for their time on the call. I appreciate your time this afternoon. Thanks very much.
Thank you, everybody, for attending and the support.
Thanks, everyone.